Hey guys, Brian Davis here from Spark Rental. Super excited to be with you as always. And I am so pumped to be here today with Sam Wilson. Sam is a friend of mine going back, I don't know what, 4 years now, Sam? Somewhere in that
Something like
range?
that, yeah.
So, Sam, thank you for joining us. And we are going to have an amazing conversation today with Sam about all the things that he's done right over the last few years, all the things that he's done wrong over the last few years, and how you can learn from both of those categories. So, Sam, I'm actually going to take a page out of your book
Okay,
from your podcast.
great.
So, Sam is the founder of the Bricken Investment Group. He's the host of the outstanding podcast, How to Scale Commercial Real Estate. So, every time Sam has a guest in that podcast, he opens the show by asking in 90 seconds or less, tell us where you're coming from, where you're headed, and how you've gotten to where you are today. So, Sam, let's hear it from you this time.
Man, I've never had anybody turn the tables on me like that. 90
Really?
seconds is tough. No, I appreciate this. 90 seconds or less. Where'd you start? Where'd you get there? Or how'd you get there? And where are you now? I started humble roots. My family grew up pretty poor. We learned how to work really, really young. I remember in the single digits going on job sites with my dad late at night, coming home. Like we just didn't have a lot. But what we did get was a work ethic. And I think when you grow up with a work ethic, I wouldn't trade that for anything in the world. I'm not terribly bright, but I do know how to work really stinking hard. And so with that, growing up poor, you always decide that no matter what, you're going to be able to provide for yourself. And so that's something you can't take away. That said, there also comes with that the double-edged sword of always thinking you need to keep providing and doing more. So I've tried everything I think under the sun. Someone mentioned career yesterday, and I'm like, career? What's a career? I don't know, man. Like I've tried everything there is out there, and I'm sticking with what I'm doing right now. I love what I'm doing right now. But that said, I've done a lot of different things. I've been in real estate now for 11 years, which is crazy to say. In that 11 years, I've done every iteration of real estate. Where am I now? We own a bunch of laundromats. We have a laundry fund. We own a bunch of land across the Southeast. We are passive investors in a bunch of deals around the country with other sponsors. We've also been capital partners on a bunch of deals around the country, from self-storage to multifamily to the list goes on. And so, yeah, I mean, that's that. But our primary focus right now is in the laundry business. We own RV parks. We got, again, hands in a lot of different things. But how'd I get there? And again, it just goes back to being willing. I think I'm learning what the word risk means in a very painful way right now. And we can talk about that if you'd like. But I think I got there by just being willing to go out and do it and then figure it out along the way. So hopefully that was 90 seconds or less, but probably not.
It was close. No, that's great. So, I've invested with you in one of the deals that you've raised funds for.
Yep.
You and I were talking before the show that, it's been a difficult year for you in some cases. We're talking about 2023. We're now in early 2024, but 2023, your fund has done great, but some of the deals that you co-sponsored, that you raised money for, and
Yep.
some of the deals that you invested in passively yourself as a limited partner, as an LP, some of those have not gone according to plan over the last year. And there's been a lot of that going around in 2023. Right. It was a very difficult year in this space. So one of the things that I really appreciated, you and I spoke in late 2023, and you were quite visibly upset about how a deal that you had helped raise funds for had gone sideways.
Yep.
And I appreciated how personally you took that, even though it wasn't your deal, you didn't mess up, but you felt very personally responsible for the funds that you had raised for that deal, and worried about the people that you put in there. So I just want to hear some of your thoughts about how investors can protect themselves now from those sorts of problems hitting their portfolios as we invest through 2024 and beyond.
I think a couple things. One, this goes back to me not knowing what risk is, right? Wisdom has tuition, right? Like if you're going to become wise, you're going to pay a price, just like you go to school. Like to learn something, you generally pay. So wisdom's tuition it's pretty expensive. I'll just say that. So one thing I would recommend if you're looking at a deal is to get a lot of other people's input on it. Have them pick it apart. Like don't, and this is my mistake. I made decisions in a vacuum. Where it was like, hey man, I think this guy's a great guy. I love what they're doing. I think the asset's a great asset. There's loads of runway here. Like, why would we not get in? as opposed to going, hey, here's 5 people I know that are 10 years older than me in the business. Let me reach out to them. And if you don't know them, find them on LinkedIn, find them in groups like yours where you have 100 other people there that you can say, hey, I'm going to submit this deal. What's some good pros and cons to this? What do you guys like about it? What do you hate about it? Why would you or why wouldn't you invest? And have people give you reasons why not to do it. Because I'm one of those people that probably know more, because in 2023, I'm probably close to $1 million that I need to go repay to my investors, which I will do. It is wholly on my list of things in the next 24 to 36 months to repay those investors. And I think we can, because they got in because I got in, but they got in because I got in, and I got in with, rose-colored glasses on. And all that said, that's what I would do. I would probably go back, if I could rewind 3 years ago and go, hey, Sam, take this deal to 5 people that are older and wiser than you in the business and see what they think. Because more than likely they'd have been like, yeah, I don't know, man. Here's some reasons why you shouldn't get into it. And we had, and that was on one major deal. We lost quite a bit of money with a co-sponsor. And then there was some other deals I did passively, the passive investor, that lost quite a bit of money for completely, unrelated reasons. But now that I'm going back, and I've been going through some forums and talking about these deals that are going sideways, just getting some other people's input, and they shed some light on some things. I was like, I never even considered that. Like, one of them was a non-performing note fund, which, just spit off cash for like 4 years straight at like 12.5%, 13% annually, just doing great. What they ended up doing was, when interest rates rose, they got all these notes reperforming in like 2020, right? Think about this. 2020, what are they going to reset them at? 3-4%. Well, now that interest rates are at 7, and hey, what do you think the value of those notes is on the secondary market? Nothing. Nobody wants them. So they're completely illiquid investments. And then if those 3% or 4% now reperforming notes stop performing, their value goes to zero because there's no buyer for it. So there's no liquidity into this fund as well. Tens of millions of dollars in that fund. And it just went sideways. So there's a lot. And somebody painted that picture for me. They're like, hey, well, here's four reasons why I would never have invested in this. I'm like, oh, right. Got it. So those are some of the things I would probably do. And again, I've probably answered your question in a lot more than what you asked for, but that's where I start.
Well, there's so much there that you just said that I appreciate. First of all, I do completely agree that wisdom has tuition. I've lost a ton of money on real estate over the years. Fortunately, it was all my money and not other people's money.
Right.
But yeah, it does. It takes losses to learn what you're doing, and to grow as a person. Skills, that requires tuition, that education and their kind of hard skills kind of stuff, and the personal wisdom and equanimity that also requires tuition. So I love that you said that, if going into it today, as someone who's continuing to invest in real estate, you're focused more on risk than on reward and upside.
Yep.
And how you can reduce that risk further by crowdsourcing that risk analysis.
Yes.
That's one of our main focuses in our co-investing club, right? So every month we get together, we vet deals together, and people are just firing questions left and right at different sponsors. Questions that may not have ever occurred to me. In fact, in many cases, did not occur to me. People bring niche knowledge. Like, we have a woman in our club who works in the insurance industry, who's just grilling sponsors left and right about their insurance projections for premium growth over the next few years. People with niche knowledge about certain markets. We had a woman who lives 5 minutes down the street from an apartment building that we ended up investing in, but she was able to tell us about the neighborhood and what the supply and demand is like in that exact neighborhood.
That's
and about the property. So yeah, crowdsourcing that risk analysis is just huge.
Yes.
And again, it doesn't have to be our club, but joining some kind of community of other real estate investors and getting their feedback, that can really help you reduce risk. And it's funny. I was speaking with a woman in our space a week or two back, and we were talking about how some of the biggest names in the commercial real estate and private equity real estate fundraising in this space, the biggest names have collapsed the hardest over the last year. And I'm not going to name specific names, but the companies that everyone told us were like the really big, trustworthy, reliable names, those have been the ones that we've been really worried about that we invested with. And the smaller operators, the mom and pop operators who didn't get quite so far out ahead of their skis, right? Because they just didn't have the name power to raise massive funds just on their name alone. Those have actually been okay so far. So, and like you yourself, as kind of a mom and pop operator running a relatively small fund, your laundry fund's doing fine.
Right.
So, yeah, I think that there is something to that a lot of the big names just got a little too big for their britches. They started relying on name recognition alone, started focusing more on volume than on quality of the deals that they're doing. Anyway, I don't. There's a question buried in there somewhere, but I lost track of it.
No,
So,
I think you're absolutely right, and I think the trick here is that it's not like there's a small or a big that's the right answer. But I do think the way you said it was that crowdsourcing risk analysis is super powerful. Because I mean, you can put money with a big operator for good reason, and it can be a home run. It's just as well as you can with a small operator. And there's there's strengths that big operators can leverage in bad times where hopefully the key principals and people like that have the equity backing and the personal net worth and the balance sheet to make sure these things move forward that maybe the small operator couldn't. And conversely, there's things that the smaller operator can uncover that the big operator just has too much of a machine to feed to even begin to take down those smaller opportunities that may be just gold mines. Laundromats are a case in point for that. Like we're under $1 million per store, which I know $1 million is a lot of money. Don't get me wrong, but it's not $100 million multifamily asset. And if you have a machine that has 200 people on board that's going out and buying $100 million multifamily asset, once every 2 months, well, and they need that giant bite in order to keep the machine fed. Well, $1 million laundromat's kind of a nuisance to a bigger operator. But yeah, that doesn't mean that there's not opportunity inside of those. So all that said, I think one of the, and you said it very succinctly and much clearer than I did, crowdsource your risk or your risk analysis, because I think that's incredibly powerful.
So we were talking before the episode how you're on your 700 some episode with the How to Scale Commercial Real Estate podcast. You bring in these great sponsors, operators, GPs, whatever you want to call them, professional investors who raise capital on their deals. So you've interviewed more GPs than probably anyone else I've ever met. So I'm curious to hear some of your takeaways after 700 and some interviews of general partners, of people raising funds for these private equity real estate deals. What are some of the things that you have learned, and when you are currently appraising deals to consider for your own investments, what are you looking for that maybe the average schmuck just isn't thinking about?
Yeah, and not to toot my own horn, we're almost at 900 episodes.
Oh wow!
Yeah,
so I stand corrected.
Right. Yeah, but it's been fun. I've been honored to have that many people be willing to give their time and come on the show. That's it's been a lot of work, but it's also been very insightful. I think one is that there's been a lot of people out there that have lost a lot more money than I have. And I guess that's
sure.
kind of comforting in some respects where you're like, oh, well, suddenly I mean, $1 million to me is a lot of money. I mean, a whole lot of money. But, there's some stories out there where you just want to crawl in a hole and you see that they were able to somehow dig out. And you go, okay, you know what? So I don't have to learn the lessons the way they did. The other thing I think is that, and this is kind of a lesson I'm learning right now, is that I don't have to copy what everyone else is doing. Like there's part of me that wants to go like, oh, hey, there's syndicator X, Y, and Z, and they went from 0 employees to 300 employees in 3 years. And look, I got $18 billion in assets under management. And I'm like, I want to build something that's meaningful to my investors, that's meaningful to me, and meaningful to my family, that gives me my time back. And if that means I have a income that is 1/100th of the income of maybe some of these big syndicators and other people, so be it. So I think that's one of the things that as I've interviewed people from across the spectrum, from little mom and pop startups to people with 10 companies to, I mean, I've had the CEOs of some of actually the largest logistics company in the world on the show, and it's like I don't have to go there. I don't need to go there necessarily. So finding I guess watching all of these people, and because they say success leaves clues, like that whole idea for me, this is kind of a personal, just what I've learned is like, what and who said this? I was reading the book Profit First, where he says like, hey, you know what? Don't grow for growth's sake. Just don't do it, because so many people do. So I think that's one of the things as investors, we oftentimes think that, oh man, you know what? We absolutely must be investing in syndications. Maybe, maybe not. Maybe a single family house is okay, or 5 of those is okay. Maybe it's okay to stay small and manageable and keep it light. And I don't know. So all that said, I think at the end of it, I kind of looked at it, and probably the number one thing I'm ingesting right now is the freedom to do what fits me and my family and my investors' lifestyle. And outside of that, I'm not too worried about it. So hopefully that made some sense. If not, none at all.
Well, no, it does make sense, and there's no right or wrong. Well, there's a lot of wrong ways to invest in real estate, but there's no one right way to invest
Right.
in real estate. I mean,
Right.
there are endless real estate investing strategies and niches, and there's not necessarily one that's better than the others.
Right.
I mean, and that's actually one of the core values of our investment club is diversification and
Mhm.
being able to invest with different sponsors every month and different cities every month, different types of properties every month, from self-storage to mobile home parks, multifamily, RV parks, all that stuff,
Yep.
to just get as much exposure to the market as possible, knowing that I don't have a crystal ball that's any clearer than anyone else's, but the law of averages is going to protect me in the long term. So
Right. Right. Yeah, I had an investor call me today. He's like, "Hey," and savvy investor, but he said, "Hey, give me a rating, of all the things he's invested in." He's like, "Give me an ABC rating on these." We gave our ratings. There was nothing that were C's, but minus the deal I told you about last year that went completely belly up. That's below C. But sorry, you gotta laugh at some point in your life and just go, "Oh well, gotta deal with it." So yeah, but that's it. Like you said, law of averages, figured out that okay, not everything's gonna be a home run, but as long as you again, use we've said it many times here, but using people around you to help you vet your deals, and I think that law of averages will come out much better in your favor.
yeah, and you mentioned how there's not necessarily a need to invest in huge properties, right? And for many people, investing in smaller deals makes sense. I mean, so yeah, I mean, we've invested with like Rise 48, which is enormous, and then we've also invested with a guy who it was a deal of 11 little cabins that he rents as short-term rentals, right? And we're about to bring in a guy who he's a house flipper, single family house flipper, and is looking for some flex funding, but he has a big portfolio of rentals as well that he's putting up as collateral for the deal. And I mean, it's all single family homes, right? I mean, it's
Right.
it's a small deal. This is actually the first time that he's ever taken outside money from people that weren't friends or family. So
Mm.
yeah, there's there are endless ways to approach real estate investing.
There
Not
are, and I will say this is one thing, right now we're not taking in capital on the LP side. It was kind of a strategic decision we've made earlier this month where it just said, "Hey, you know what? We can self-fund our growth from this point forward." One thing we are doing though, and this is something for people just to think about, maybe not necessarily with me, but with other people, is what does it look like to get in on the debt side? So for me, if somebody came to me and said, "Hey, I want to loan you money, and here's the fixed interest terms, and this is what it looks like to repay that debt," man, we'll take debt all day against the right asset because one, it's easier for us to manage debt than it is for us to manage equity. And two, right now, I think is a great spot to be in debt, just because not in debt like as in acquiring debt, but in debt as in being the lender.
investing in it. Yeah,
Yeah, right.
lending money.
Because especially if you can get a first position, low loan to value secured loan, like, man, okay, do that all day, clip the coupon. Maybe it's 12, maybe it's 15%. And again, I don't want to sound like I'm too schizophrenic and all over the place, but we've got our hands, like I said, in a lot of different things. And they're and I don't have a partner of mine that handles 99% of the work on this. So I have very little to do with it other than the funding side of it, funding and getting us closed and kind of, trading on some credit and other things. But we buy land all over the Southeast and we're always using short-term debt on that. And they're just, I mean, they're quickly, and I got a lender. I've worked with him for gosh, 8 years at this point. I just call him on the phone and say, "Hey man, I need X number of dollars for this asset closed by then." And he's like, "Okay, great." And he's loaning loan to value. So we're buying stuff at half a market price. He's loaning on 70% of that. So what is 7 times 5? 35. So he's 35% of market value all in on his loan, first position. And he's clipping 12 to 15%. on that money. So I think and those opportunities are everywhere on the debt side. So I think that's another thing to think about, especially right now, is that if there's opportunities to get first position with some low loan to cost or loan to value on the debt, man, that's something it's a pretty compelling space right now, I think, for a lot of people.
Well, I agree, and we've done some note deals and some debt investments in our club, and I personally have, even outside of our investment club, I've got some personal money tied up in private notes and in hard money loans that are secured. So I agree, it is a good place to be in right now. That being said, I've heard a lot of people make that same case for right now. And you and I were just talking before the show about being contrarian and just questioning the herd. And I loved what you said earlier about how you don't have to do what everyone else is doing. And there's that interesting balance between being inventive, coloring outside the lines, but also not reinventing the wheel. I mean, it's been so. No one else, Denny and our business model for the co-investing club, no one else is doing what we're doing, but it's also been really hard to make it profitable,
Right.
So, we have plenty of people in the club, and of course we're growing it every day, but because we're doing something that's so different, it's hard to, we're not following a tried and true business model. So
Right.
yeah, it's hard to keep that or to make that profitable when you're not painting by numbers, right? You're kind of
Right.
making it up as you go along. I want to be respectful of your time, but there's a final question I want to ask you about. Just given your experience, both raising funds and investing passively as an LP, and just all of your deep experience in real estate, what are some of the risks that you see in the current real estate market, particularly what risks that maybe not enough people are talking about, and how are you approaching mitigating some of those risks?
Yeah. So several things. I mean, one risk I see, obviously, and this is nothing profound, is short-term debt coming due. And that's really what
Yeah.
got us pinched. Well, that was one of several things. One was, but I won't go into the details on that story because we don't have time for it. But in general, be leery, I think, of short-term debt. Fixed rate, long-term debt is the real estate investor's best hedge against inflation. So, I mean, think about that. You get to borrow in dollars. I had no loan against my primary home until last year. I saw interest rates early last year, late 22, and I'm like, man, I should get a 30-year note on this house because interest rates are climbing. Inflation's off the chain. So why not do that and lock in a 30-year fixed note? I get to borrow in dollars and repay in dimes. Like that makes all the sense to me, but that's long-term fixed interest rate debt. So look out for short-term variable rate debt. That's something I think that we're going to see a lot of that debt come due in 24. What is it? It's north of $1 trillion is coming due this year. So that's one thing that's kind of a no-go. And again, this is risk analysis. I've made the mistake of investing in a syndicator's first time doing a particular asset class. And here we are
Yeah.
5.5 years later with nary a penny in return. And we have multiple hundreds of thousands of dollars of our own money in that deal. And that's bloody painful. Five and a
Yeah.
half years later, I'm like, golly, man, I could have put this in a CD and made more money. And it's still in the red month over month. And it's like, okay, well, I just hope at this point we get our money back. So those are some other things I think right now that are kind of painful. One thing that we're really stressing, and again, I'm not raising money for this. I got nothing to sell anybody, but that I am pot committed to is whatever I do, it needs to be inflation resistant and it must be cash flowing. So, and it also by inflation resistant, cash flowing, and recession resistant. So in the laundry business, I mean, behind food and shelter, the third thing most people want is clean clothes. And our business boomed during the pandemic. And only thing we see is just up into the right trajectory of it. It's like, well, okay, every store we build, every store remodel, we take it from doing X to doing, Y squared. And it's like, the worse the economy gets, the better our business does. And we can reprice our stores. So think about that. We can reprice our stores daily like a gas station if we wanted to. We don't, because that would get really annoying. But we feel like, oh, yesterday it was 8.75 and now it's 9.25. And so whatever, we don't do that. But all that said, so I'm looking for those things. So when you're looking at investments, I think, not just being solely real estate focused is helpful, but finding finding inflation and recession resistant businesses, cash flowing businesses, something else that's really part of my strategy right now. I'm not swinging for the fences. I'm swinging for stuff that it's like Robert Kiyosaki model. Find stuff right now that prints cash month over month over month and just stay in that lane. And soon enough, it'll become meaningful.
Well, I love it. And I know I said that was your last question. I got one last fun one for you. You were asking me about Uruguay before we hit the record button. So I'm just curious about your fire escape plan, your financial independence escape plan here. What's the strategy?
That's a great question, Brian. And again, I'm contrarian, so just know that that's kind of the way I think. Yes, I have bug out bags. Yes, I have all the stuff. Like even on the bug out bag, there's like, hey, grab these 3 things and run. I do live in Memphis, so this is a present reality at any given time. So if you own a television, you know what I'm talking about. But that said, is that I think the U.S. dollar has enjoyed incredible privilege over the last, 60, 80 years, from Bretton Woods to you name it. We have lived on the trading power of the dollar. The dollar has been the world's reserve currency this whole time. And somebody said it here maybe 10 years ago. They said when you start seeing oil traded in things other than dollars, because the petrodollar is what the world has traded oil on, so then you know that the end of the dollar is nearing, and we're seeing that now. The dollar is getting traded. I mean, look, we've printed how many trillions and trillions and trillions of just fake money. And so the world, soon enough, they've been buying all of our bonds and buying all this stuff, but our government's broke. I mean, they're flat broke. And so when the hens come home to roost, I think it's going to happen kind of without warning. And then we're going to be going, oh, crud. Now what do we do? So for me, a second passport, it's literally the very top item on my financial to-do list, as it's taped to my mirror in my bathroom. So like I'm brushing my teeth and it's sitting right there. It says second passport. And so that's, again, there's nothing wrong with a get out of jail free card. You can play it anytime you want. And Uruguay's a great country. I mean, everything I read about it, it's not the most geographically exciting place. It's pretty flat. I think the highest elevation is like 1,500 feet, which I love the mountains. So there's not really much there in the way of that, but it is independent. It is a food independent, energy independent country that has a very conservative, I don't even like that word because nobody even knows what conservative means anymore, but has a very kind of freedom-minded government system. And I think that's important for anywhere you want to go. If you don't want to get bled to death by taxes and overbearing governments, man, that's kind of one of the places at the top of my list. So there you go. Those are my thinking. That is my thinking behind why Uruguay.
Well, I love Uruguay. I visited once, and yeah, politically stable and centrist. It's economically stable and centrist.
Right.
Great wine, great wine, great beef.
Great.
And right across the river from Argentina. So, and there you do have skiing and mountains, and you've got the major city of Buenos Aires. And anyway, Sam, thank you so much for hopping on today. This was a blast. We hope to have you back soon. So thanks again.
Thank you, Brian, for having me. It's great to see you again, as always.
All right, guys, if you enjoy these conversations that we have on here, please rate, review the show. It means the world to us. And reach out anytime, support@sparkrental.com, and we will catch you on the flip side.